Janet Yellen sucks, and pretty soon that's going to be the biggest problem facing the economy. What's up, guys? I'm nobody special, and while all the attention right now is being paid to the debt ceiling and the fallout from the debt ceiling, and oh my God, are they going to raise it? And it would be catastrophic if they didn't. It's what comes after the debt ceiling that we need to start worrying about. Now, let's assume for a second that the whole world economy doesn't go up in smoke and that they do actually raise the debt ceiling. It's what Janet Yellen does as soon as that happens that you need to worry about. Now, let's think for a minute. You're Janet Yellen. You just got done with this debt ceiling mess. The Treasury General account is empty. You almost ran out of money. Whew, that was close. What's the first thing you think Janet Yellen is going to do as soon as the debt ceiling gets raised? She's going to hoover up every single dollar she can. She's going to issue a whole bunch of new U.S. Treasuries, new government bonds. She's going to put that new bond supply on the market, and she's going to borrow a lot of the available supply of dollars in the bond market. In other words, she is going to suck up all of the liquidity in the bond market at a time when the bond market and the banks and the real estate market is already struggling for liquidity. And it's not like the Federal Reserve is going to buy them. They're still engaged in quantitative tightening. Jerome Powell's not just going to go burr and print money in order to buy up all these new bonds that Janet Yellen is going to dump on the market. Keep in mind, the Fed is already engaged in letting the bonds they've already bought roll off the balance sheet. So the Fed is also draining liquidity from the bond market right now. And even though I've been talking about this on my live streams every morning for a couple of weeks now, finally somebody in the mainstream financial press is starting to cover what comes after the debt ceiling. This is in Bloomberg, dated just this morning. A $1 trillion T-bill deluge is painful risk of a debt limit deal. And the move could drain liquidity from the system, hurting riskier assets. Looming behind market fears over the prospect of a historic U.S. default is the less discussed risk of what would follow a deal to resolve the debt ceiling impasse. Many on Wall Street predict lawmakers will ultimately reach an agreement, likely averting a devastating debt default, even if it goes down to the wire. But that doesn't mean the economy will escape unscathed, not just from the bruising standoff, but also as a result of the Treasury's efforts to return to business as usual once it can ramp up borrowing. And of course, with the government, what they mean by business as usual is mortgaging our future to borrow money like it's going out of style and then wasting it on stupid social engineering and starting wars all over the planet. What the market veteran is getting at is that Treasury will need to scramble to replenish its dwindling cash buffer to maintain its ability to pay its obligations through a deluge of Treasury bill sales. Estimated at well over $1 trillion by the end of the third quarter, the supply burst would quickly drain liquidity from the banking sector, raise short-term funding rates, and tighten the screws on the U.S. economy just as it's on the cusp of a recession. By Bank of America Corp's estimate, it would have the same economic impact as a quarter-point interest rate hike, and my gut tells me that BOFA's lowball in there. I think borrowing $1 trillion between now and the end of the third quarter, that's not very much time. That's going to have way more impact on the market than just a 25 basis point hike. Now, the reason why I'm so worried about Yellen's sudden surge of borrowing up to $1 trillion is the effect it's going to have on the strength of the dollar and on interest rates. Keep in mind where the government gets money. The government gets money by issuing bonds. So what happens to the bond market if demand stays the same, but there's a sudden dumping of new supply into that market? Supply goes up, demand stays the same. That means price goes down. Well, with bonds and U.S. Treasuries, the prices and the interest rates are inversely correlated. So if Janet Yellen suddenly dumps a whole bunch of new bonds onto the market and crashes the price of those bonds, that means the interest rate on those bonds is going to go higher. And higher interest rates on U.S. Treasuries also means higher interest rates on things like car loans, mortgages, credit cards, commercial real estate. Basically anything and everything that people borrow money to buy. The interest rate on that debt is based on Janet Yellen's U.S. Treasuries, and Janet Yellen is about to send that interest rate much higher. Another way to look at it is what's going to happen to the supply and demand for dollars. Well, Janet Yellen borrowing $1 trillion, that is a sudden surge of new demand for dollars. Well, Jerome Powell is not printing them anymore, so the supply is fixed. If the demand for dollars goes up and the supply of dollars stays the same, that means the price of the dollars is going up. And what's the price of dollars? Interest rates. So either way you look at this, Janet Yellen is going to send interest rates higher just as soon as she gets the all clear from Congress to do so. And you can already see that in some of these charts. Now, this line right here that's about to put a hole in my ceiling is the Dixie or the DXY. This is the US dollar index, the strength of the US dollar as measured against other world currencies like the euro, the yen, the Canadian loonie, the Australian dollar. And as you can see here, the dollar is right now getting much stronger relative to other currencies in the world. The currency exchange market is already starting to sniff out that there is a dollar shortage on the horizon. Now, if the debt ceiling gets raised, the Dixie goes higher because Janet Yellen hoovers up all the dollars, increasing the demand for those dollars and sending the price of it higher. And of course, the alternate scenario is if the debt ceiling doesn't get raised, the Dixie's going to go even higher as interest rates spike to near infinity because anybody who has dollars becomes unwilling to lend them in that scenario. Either way, the DXY, the US dollar, is going higher, and that's going to put downward pressure on the price of assets. Assets like gold, which right now are doing the opposite of what the dollar is, heading much lower. People are starting to realize that dollars are about to become more scarce. When dollars become more scarce and the dollar goes higher, that sends asset prices lower. Everything from gold, silver, to stocks, bonds, and real estate. The price of all of those things tends to head lower when the dollar gets stronger. And that is really bad news for banks, which are already sitting on a $620 billion pile of unrealized losses on their books. Those losses have been driven by higher interest rates because what do banks own a lot of? Banks own a lot of U.S. treasuries, they own a lot of bonds, they make a lot of loans, all things that get less valuable when interest rates head higher. So Janet Yellen borrowing $1 trillion in a span of a couple of months is going to put even more pressure on banks, which you may recall banks have had a rough go of it since the middle of March. And it's also going to hurt office buildings, retail space, multifamily housing, in other words, commercial real estate. Check this one out. Rising rates, tighter lending, and remote work squeeze commercial real estate. Well, Aunt Janet's $1 trillion deluge is going to send those rising rates rising even higher, and that tighter lending is going to get even tighter under those scenarios. So it's going to make the commercial real estate problem worse also. And let's not forget that little zombie problem the economy has. Remember over the weekend, credit crunch fuels 48-hour bankruptcy rush with 7 filings. That's right, we had 7 large corporations all filed for Chapter 11 bankruptcy over the weekend. Why? Because it's getting more expensive to borrow money, and we have zombie companies all over the economy. The only reason they haven't gone out of business yet is because they've been able to borrow cheap debt in order to keep cash-burning operations alive when they should have died a long time ago. Well, that is starting to become a problem. 7 different companies filed for bankruptcy over the weekend. That problem's going to get worse when Janet Yellen borrows $1 trillion. So take a break from worrying about the debt ceiling for a second and start thinking about what might come after the debt ceiling. You can sit there and you can listen to Janet Yellen when she assures you that our banks are safe and well capitalized and that Americans can feel that their deposits are safe in our banks. Or you can look at the trend of banks failing, commercial real estate values tanking, and companies going out of business because interest rates are so high, and then ask yourself what happens when Janet Yellen borrows another $1 trillion and sends those interest rates even higher. Till next time, live small and dream big.